Let me paint you a picture. It's April 14th, you've had a decent year, you sit down with your accountant, and she tells you you owe $8,400 in taxes. You don't have $8,400 sitting around because nobody told you as a self-employed person you're supposed to be paying taxes 4 times a year. You were just waiting until April like you always did. That scenario plays out more than you think. Today we're making sure it doesn't happen to you. Welcome to Cash Grab from Benchmark Ledger Solutions. I'm Kimmy. Today we're demystifying quarterly estimated taxes. What they are, when they're due, how to calculate roughly what you owe, and how to make sure you're never caught off guard at tax time. Here's the basic concept. When you work for an employer, they withhold taxes from every paycheck and send that money to the IRS on your behalf throughout the year. When you're self-employed, nobody does that for you, so the IRS asks you to do it yourself. 4 times a year. These are called quarterly estimated tax payments. The due dates are typically April 15th, June 15th, September 15th, and January 15th of the following year. Miss them and you may owe a penalty. It's not huge, but it could add up if it's completely avoidable. So how much should you be sending in? There's a rough rule of thumb called the safe harbor rule. If you pay at least 100% of what you owe in taxes last year, or 90% of what you'll owe this year, whichever is smaller, you won't be penalized even if you end up owing more come April. For most new business owners in their first year, where you don't have a previous year for reference, aim to setting aside 25 to 30% of every dollar of net self-employment income. That might feel like a lot, but remember, you're covering both self-employment taxes and income tax. Here's the practical system that works really well. Every time you pay yourself from the business, immediately move 25 to 30% of that amount into a designated savings account, not your emergency fund, a separate one just for taxes. Call your tax account. It earns a little interest. It sits there when the quarterly deadline hits, and you never accidentally spend it because you know what it's for. To actually make the payments, you can do it through IRS Direct Pay system at irs.gov. or through the electronic federal tax payment system, which is called EFTPS. Both are free, both are straightforward. Your state likely has a similar system for state income tax if your state has them. For reference, Michigan does not. This isn't something to lose sleep over, it really is just a system. Set aside a percentage and make the payments on time, and you'll never have that April panic. Here's the grab. Quarterly estimated taxes are due 4 times a year, April, June, September, and January 15th. Mark those dates down now. Number 2, set aside 25 to 30% of every personal paycheck in a dedicated tax savings account. Don't mix it with your personal emergency fund or regular savings. And number 3, pay through IRS Direct Pay at irs.gov. It's free, fast, and you'll record every payment. Cash Grab is Benchmark Ledger Solutions podcast. If you'd like a more precise estimated tax calculation based on your actual numbers, that's exactly what our team does. Visit benchmarkledgersolutions.com. Next week, we're talking about the home office deduction, one of the most misunderstood tax benefits available to business owners. See you Monday.